Well, good morning. It's August the 6th, 2021. This is Bill Riley with Riley Private Client, and today we're going to talk about a fantastic jobs report that came out this morning. I try to keep these very relevant to what's going on, so I hope you appreciate that. And I usually write them on the fly, so we'll get through this one. Jobs are coming back. The morning jobs report was about 943,000. Where some estimates were as high as 1.2, and then some idiot said 600. So, it's all over the board. But the good guys, the smart guys, said they were pretty close to this figure. It was a little bit better than they even thought. So it was strong by any measure. The job raised down to 5.2%, or right at that figure, 5.2, 5.3. That's very good. So we are starting to see a rebound in the economy and the jobs coming back. Now, we're not to full employment by any means. There's still a lot of job openings out there, as you can see if you drive around and see all the job openings. But we're getting there. And I think the big turnaround will be is once we get September and some of the, what I call free money goes away, people will go back to work. One of the problems is when you usually get a really good report like this, you expect the market to just jump. But here's the problem. We are less than 1% off the all-time highs. Markets form resistance lines. There's one on the top and there's one on the bottom. We're hitting the top. So it'll take some real emphasis or some real momentum in the market to get through what's now the top that will form that as a bottom. But it will take time and it'll have to work itself out. The problem is that the market right now is overbought. I have an indicator I look at every morning to see where we are. We're about 22% overbought. So that means a lot of the sectors, I have all the sectors in the S&P on my platform. We look at what's overbought and what's oversold. And we're getting more overbought than we're oversold. One of the big sectors is growth. That would be normal in this market. That's nothing to get excited about or upset about, but growth has outperformed value. Now, the reason we're not seeing a substantial upside is since the markets have already priced it in. A lot of people don't realize that when we're putting portfolios together, we're anticipating something like the thing we had this morning. It's not a surprise to the markets. The markets are always ahead of us. So they've kind of priced in this resurgence of job growth, and that's not that hard. It didn't take a crystal ball to figure out if you got 9 million job openings, they're going to start filling up eventually. The next concern I have, and it's one that has really started to bother me, is valuation. Valuation means what are stocks really worth compared to the price? And valuations are getting a little stretched. And you see a good indicator of that with some of these what they call meme stocks, or even the one that we've all heard about, Robinhood. What's funny is there's a guy that created a small hedge fund to trade Robinhood and that kind of thing on his own. And he named it Friar Tuck, which I thought was, that's pretty inventive. Friar Tuck, Robinhood, got it? Okay. But here's where we are. One of the things I've used since I studied economics was there was a guy named James Tobin years ago, great economist. You ought to look up some of his papers and his writings, called the Q ratio. And this is the basis of Warren Buffett's valuation model. What it means is this, is he compares the balance sheets of corporations. Now, there's no noise in this. This is true figures from an accounting standpoint. The valuations of the balance sheets to the price on the S&P. As long as the valuations are above the price on the S&P, you can buy. When it gets the other way, you need to start looking at where you may need to trim, where you need to take profits, or do you really want to invest new money in it, or will you wait for a pullback? That doesn't mean you're going to have a crash or anything like that. But the basis of good investing is price. You want to buy at the right price. So here's where we are. Now, if you want more information on the Q ratio on Tobin, you'll have to hire me to teach a class. It takes about 3 hours to go through it, but I'll summarize it. It makes a lot of sense when you think about it. So I ran a chart back to 1900, and where we are now, we've never been this high. That was shocking to me when the computer spit it out. In 1999, remember the tech wreck? The Q ratio was at 1.61. And then what happened? The tech wreck. If you had .com behind your name, you made money, even though you were really losing money. If you'd applied the Q ratio, you would have never bought the stock. We are now at 1.91. So we're higher from a valuation standpoint, a negative valuation. In fact, in quarter two, I was able to get the calculator to work. We're at 1.72. So we're higher than we've ever been since 1900. So what does this mean? What it means is we have to be careful, and we have to assume that at some point in time we're going to have a regression, is what I call it. Now, this is not a short-term indicator by any means. This is a long-term indicator. So when I'm looking at portfolios and we're trying to readjust or rebalance, what we do is I'm looking for those indicators. Where are we overvalued? Because eventually everything, water seeks its own level. So if we do have some interruptions going forward, that's where the source of funds, I call it, to be. But I'm looking at portfolios using the Q ratio to where I need to be 12 months, 18 months from now. Not next week, because we're going to have a lot of stimulus coming in, and it will continue to push this market up. If Uncle Warren was in the room, he'd tell you right now to be careful because the valuations are skewed. A lot of this because of the low interest rates. That's what's caused a lot of this. Bottom line, we are still in a bull market by any indicator I see. But at some point, we will have a regression moment. So you need to watch where your risk is, measure that risk, and see if you want to assume that risk, is what I tell people. If you can stand the pain, stay in. But if you want to kind of lighten up or change where you're investing or buy more high-grade bonds in your portfolio, this may be the time to start allocating to that. No one has ever faulted me for taking a profit. Here's the big question for the weekend. Infrastructure or no infrastructure? I cannot believe, or I can't believe, that we are hassling over a very, very good bill that would pump real money into the economy because we can't get people to agree on what I consider minor points. And it's kind of disappointing. And I think the whole world is laughing, The other part of the infrastructure is it's not going to have an immediate effect. Everybody keeps waiting. Well, the market will really go up when the infrastructure gets approved. Here's the problem. Let's say that we get the money. And we go out and say, boy, we need to fix that bridge. It's in bad shape. It'll take 3 years to get a permit to fix the bridge. That's the other problem with this is we have a government that can't get anything approved. So I'll end on this note. Everybody's worrying about the vaccine. People take it, some people won't. Heard a story the other day where the guy got it, took the shot, and he said that his arm felt like a magnet and he could put things on his arm and they would stick. I don't believe that whatsoever. But that's the conspiracy theory. The other part of it is, well, once they make it approved and take off the emergency, then I'll get the shot. Well, you got almost 70% of the people in the United States that have already had the shot. I don't think it's still an emergency, people. So I'll end on this note. I know there's a lot of people who don't want to take the shot, but that's the only way we're really going to conquer it. And this new strains, this will be with us for years. And it keeps developing these new strains. The only way to fight that is to get the shot or get the disease and get it over with. So I'll end on that pleasant note. I'll have to say that I think getting the shot might be a good idea because this thing is developing these strains that we really don't know the effects. But we have proven that the shot does keep it from being very bad. Well, we'll go over some more of these next time. I think that the market's in fairly good shape here. I mean, get people back to work, get money back into the economy, things will be fine. But at some point, if these valuations keep getting stretched, we're going to have to address them. Well, thank you very much for listening. Hope you pass this on to people that might want this information, and I always appreciate that. I appreciate referrals. The best thing I can get is a referral. So we'll end on that note. Have a great weekend. Enjoy the rest of what's left of this summer, and we'll see you on the turn. Bill Riley, 817-870-4680, and you'll see the email site on the video. So thank y'all very much, and have a great weekend. Thank you.